A key ingredient to creating the biggest and most successful bullish patterns is, surprise, surprise, enhanced volatility. Now, if this sounds like the complete opposite of what we typically talk about, that's because it is. But there's one key difference. Elevated volatility is a necessity to creating these biggest patterns and, most importantly, the highest targets. But after the breakout is when we need low volatility to then come back into the trading environment, because that is what gives us the ability to have that breakout and then turn into a more consistent and long uptrend, which we see now over the last 2 years. So today we're going to investigate both sides of the equation, which is going to be especially helpful for right now, considering the volatile start we've had so far in 2025. So if you think about it, volatility and breakouts go hand in hand. And I think the best example of this is one that we've just seen take place. Now, this was the biggest pattern that we've had in place for a few years now. The 6100 breakout that we had, of course, occur in January 2024, and it was finally hit at the beginning of December at the end of last year. And you think about this, how did this huge upside objective actually come about? Well, we reviewed it in a few videos ago when we talked about actually achieving this target. What we stressed was if 2022 didn't happen, we didn't fall more than 20% from the high, there's no way that an ensuing bullish pattern of this size and magnitude could have gotten created. And so on the way back, this was a 37% move just to get back up to 4,800. And the ensuing breakout was a 27% advance. So in terms of the pattern targets we have in place now, they're nowhere near that high. And that's only because we haven't had this type of enhanced volatility take place over the last 2 years. Does that mean we need a big bear market for that to occur to get one of these again? Well, eventually, to get in a target that much higher, we need a lot of preceding volatility to take place. So while we're not looking for that, it is important to recognize that any of these different bouts of volatility that we've seen recently and may continue to see in the next few months could eventually lead to the next big target. And so let's look at currently what's been going on over the last few weeks. And we talked about this last time. It really looks more or less like a broadening formation, right? Higher highs, lower lows. And as we can tell, the range just continues to widen. And so typically shows, of course, is enhanced volatility and investors looking for direction, a lot of back and forth movement. And of course, we can understand why. There's been a lot of information and data to sift through in the first few weeks of the year. We don't have to review it all. It's reflected in what the market has done in response to it. And so that is, of course, a concern, considering that we just came off of a very strong 2-year run where the volatility overall has been relatively contained, at least if we don't zoom in. So let's do exactly that now, take a closer look at what's been going on recently, but also what has taken place over the last number of months. And so if we look closely here, and we talked about this on X a few days ago, we see this pattern repeating since the March highs of 2024. And even though we're up considerably through that point and have repeatedly made new highs, it's more of a 2-step forward, 1 step back scenario than a straight shot higher. And some of these pullbacks have lasted for longer. Some of them have been more severe, like we saw from July to the August low in 2024. The process has just been seeing a breakout, make marginal new highs, have a pullback come, and then having that dip bought over and over again. Even though the market is up a good deal from last spring, it definitely had a character change when it entered March of last year. And we have this annotated right here. And the reason why is because from the initial burst from the October 2023 low, it produced one of the most non-volatile multi-month advances we've seen in quite some time. And along the way, we were showing how small these pullbacks actually were. Between 1% and 2%, not much more than that at all. There was no variation. Yes, we could buy the dips at any time the market paused, but there was nothing in terms of any sort of a volatile pause along the way until, once again, we got to that March high there, and this produced a 6% drawdown. As we can tell below by the rate of change, we still didn't have a lot of 1% moves, as we've talked about a lot in 2023 and 2024. That number for the year was a lot lower than what we saw in 2022. But at the same time, we can see that there have been many more extreme readings, both on the plus side and downside, all along the way. But even with that being the case, the market has shown the ability to pick itself back up and rally from that. Investors were still interested in buying the dip. So another way to look at this, same chart, is when that volatility appeared, what did it do? It produced the biggest bullish formations that we've seen in 2024 now into 2025, where eventually coming back from that 6% sell-off, coming back from that 10, 11% pullback, now again from the 6% pullback, the way that the market has progressed is formed bullish patterns. We've seen the breakout target hit right after the breakout in June. The breakout from mid-September of 6180 continues to be in play, and we're still in the process of potentially seeing the next breakout through 6100 to 6125 once more. And again, we've seen it before. Each one of these two in the past broke out to new all-time highs. Trust me, there are plenty of negative headlines along the way that suggest those wouldn't have lasted either. So yes, is it different this time? We know it is for many reasons. But from a pure price action perspective, we've seen this play out before and actually in the most recent past there. So in terms of live patterns, we're still looking at this bullish falling wedge breakout. It's been tested a few times, it's held. The next step, of course, is to see this now have some sort of substantial follow through, because even though this has been good, 2 Mondays in a row, being able to come back, definitely want to see more than just rallying above a downward sloping trend line, right? We're still making lower lows on a very short-term basis here. So again, seeing this get back up, seeing the S&P 500 eventually get back above 6,100 and stay above for longer than a day or two, obviously a necessity at this point. And as we just talked about, 6,180 has continued to be in play. It's been now a long time, going back to the middle of September, but the breakout zone hasn't been violated. That looked like it was going to be a risk now 2 times at least at the beginning of this year so far. And turning to potential patterns we're watching, well, there's now an identifiable classic potential cup and handle pattern in play as well. Now we could potentially connect these highs. We'll see how this next breakout attempt works out. But as we can tell, over the last few weeks, preceding volatility has created the chance for this next one to actually be completed. And if it does, we'd have a target near 64.25. So a good deal higher than 62.90. And this was only possible because of the pullback that we saw from December through the middle of January. So this pattern is, again, the one we've been watching as well. And it looks very similar to what just happened in the spring and summer of last year. Now let's talk about what's happened over the last few weeks. So far, a trend has become evident. That is, we've seen turnarounds on Monday, both on a negative and positive side. Now remember, there's only been 4 trading days that have occurred on a Monday so far this year, with MLK holiday, of course, only on January 20th. So right here we had a reversal. Market still finished higher on January 6th here. Then again, January 13th, huge reversal, ended up resulting in a weekly bullish engulfing pattern. Then, of course, last Monday, January 27th, again, coming back from the deep seek scare. And this past Monday, after the tariffs were announced over the weekend, of course, an even bigger 2% decline in the first number of minutes as well, which again was bought. And so the important part about this is that each of the 3 prior turnarounds that we had on Mondays had pretty substantial and immediate follow through to the downside, to the upside, to the upside. So seeing that happen again potentially now, of course, is a necessity if we want eventually to get that potential bullish pattern we just reviewed to actually play out. And so looking at the short-term work once more, we know that how the market had gotten short-term extended, as evidenced by the 14-period RSI getting close to 75 on a 2-hour chart, showing that even though we had just gone through that 6,100 level again, it did seem like the pendulum had swung a little bit too far. So the notion there was probably expect some sort of a pullback. That, of course, has come. It's not too substantial, down 3.4%, but it was bad enough to get that 14-period RSI almost down to oversold territory. So maybe now extended to the downside, and we see the reaction once more. So compared to what we've seen over the last number of months, this down 3.4% kind of lines up with some of the smaller drawdowns that eventually made higher lows, with the market then making new highs once more. So looking at it again from this perspective, nothing has changed just yet. And to see another new high at this point, then extend higher, that will be the next step, of course. So in terms of drawdowns, here's the updated chart across all these different scenarios, which we brought up after that deep seek induced gap down last Monday. And so again, 3.4% doesn't look too bad right now. Of course, all it did at the moment was produce a potential higher low. And so we'll keep this on here as long as the S&P continues to stay underneath its high from January 24th, and that's what we're measuring it from. But right now, again, compared to what we just saw on the short-term chart, and this is seen to pull back well within acceptable terms right now. And so now we want to end this with just two charts that keep us in line with what the market could do now toward the end of the year. Now, this first one is from Jeff Hirsch of Almanac Trader, of course, the authority and everything seasonality. And this is an outstanding chart just because of all the different data points he has here. And I urge you to check out him on X, on Almanac Trader, and also his blog and all of his premium research as well to get a much more in-depth view of everything that he talks about. But with this free chart that he shared with us, it gives us a lot of information. It shows, number one, what the S&P has done so far through January and compares it to just looking at the all post-election years going back to 1949. That's pretty much on track. And as he notes here, that post-election years have been much better in recent years, but also cautions that the first quarter has tended to be a weak spot. And we see that here, right, with the black line going down, making a low typically on average, of course, at the end of February, and maybe flatlining a bit until April. So after the first quarter is complete, that's when you see the extension. And as we've seen already, volatility is with us. It wouldn't surprise anyone to think that that's going to persist at least for another 2 quarters and probably after that as well. But in terms of the good start for the year, right, Ryan Dietrich of Carson Group, again, does great work, showed us that the S&P was up 2% last month. And going back to 1950, when this has occurred, the 11 months from February to December have done quite well. And of course, that means the calendar year has done quite well too, with the S&P up 84% of the time, again, from February to December, and up 88% of the time on a year-end basis with an average move of 18.4%. So putting this all together, the volatility that has started so far in 2025 could persist, especially through the first quarter, as Jeff Hirsch's data showed us. And as Ryan Dietrich now has displayed, that eventually could lead to investors buying that dip once more. That could set us up for a very good end of the year. So again, what does that mean? That means the volatility that we see now and potentially in the coming months could eventually lead to that big breakout, whether it happens now, whether it happens sometime over the course of 2025, and that will produce the next big pattern target that, as the last 2 years have shown us, we should respect if and when that happens. That's what we have for today. Check out these videos and subscribe, and I'll talk to you next time. Thank you.